Welcome, everyone, to Tax to the Max. This is a special edition, I suppose, in the middle of tax season, or right at the end of tax season. And it may be that many of you, like I am, have competing demands for your time. So the folks at SCAPA have graciously allowed me to pre-record this today. So while it is not live, the questions will be transmitted to me before the day is over, and I'll get back to you. Let's get through the disclaimer. We've all seen this many times. I want to emphasize my reliance on tax notes today, published by tax analysts. In my opinion, the preeminent source of current information for tax professionals. Questions, please send them to me at lynnnicholscpa@outlook.com. I will be sure to get back to you and share answers with any appropriate staff persons at SCAPA. Make sure that we keep good records of what we're doing here. We don't want to have any secrets. What's on the program this week? 7 items. It's not too late for a business to apply for the employee retention credit. I think that's important. I laid that out for you, how you can do that. You have an individual who's fighting FBAR penalties to no avail. The statute runs on the court's jurisdiction and he can't start over, and he's actually filing a writ wanting the court to retain jurisdiction. He knows that if the court gives up jurisdiction, he's at the mercy of the Internal Revenue Service. And all I could think of for that one was the text LOL, laughing out loud. Exemption denied for healthcare sharing ministry. Just because it's a ministry doesn't mean it's exempt. Remote work complicates. Anyone who's practicing in the northern part of South Carolina has some experience with how remote work has complicated your wage and hour compliance, your withholding, all that goes with that. So we may just mention that in passing. Proposed regulations address affordability and minimum value again, or some more in addition to, I think. Taxpayers are not entitled to CNC, currently not collectible status, if they can pay anything. And literally no amount is too small, apparently, for the folks at the Internal Revenue Service to want to grab it and keep you connected to making a payment every month. Finally, a business league seeking to provide benefits through an organized entity creates unrelated business income. And I think I know what it is, and I think it'll be of interest to all of us when we get there. So it's not too late to claim the employee retention credit. If you haven't done anything, and even if you have, you may be able to claim some more. You've got up to 3 years to file an amended 941 retroactively. And by the way, this is the employee retained tax credit in some writings. Some writings, it's the employee retention credit. Some places, it's the employee retention tax credit. Don't be confused by any differences in the acronym. One point of confusion is that the rules have changed more than once since the credit was introduced. The threshold for qualifying and the amounts an employer can receive are different for 2020 and 2021. They're not the same. So you may be able to go back and file amended returns for either one of those years based on trying to apply the rules from the other year when they weren't in effect. Both years provide ways to qualify and a generous return when you do. A business qualified if it had either one, suspended operations fully or partially because of COVID-19 orders, the government said shut down, or they experienced a 50% decline in gross receipts when compared with the same quarter in a prior year. And that analysis is quarter by quarter by quarter by quarter. If you have a quarter, when you qualify, you can claim the employee retention tax credit for that quarter. But wait, many of you knew that you couldn't claim the employee retention tax credit and have the PPP loan. So the PPP loan was easy. That's where we all went. And then the rules changed again. You can have both employee retention tax credit and qualify for a Paycheck Protection Program forgivable loan. They just can't be for the same expenses. Congress fixed it. The Consolidated Appropriations Act in 2021 reached back to 2020, lifted the restriction on receiving both the Employee Retention Credit and the Payroll Protection Plan forgivable loan. It even allowed employers to claim a credit against 70% of qualified wages paid up to $10,000 per employee per quarter. Now think about that. That's $7,000 per employee per quarter for the first and second quarters of 2021. What? Retroactively changed it and fixed it? Yes. Did you know about it? Have you already claimed your amended employee retention credit? More than the amount originally allowed. There's the opportunity for an amended return. But wait, don't stop. There's more. Let me press the right button. The American Rescue Plan Act of 2021 extended the end date of the employee retention credit through December 2021. Oh boy, we had a whole year, and then, as if those weren't enough to keep track of, the Infrastructure Investment and Jobs Act retroactively changed the end date of the program for most businesses to September 30th of 2021. The only business that could claim the employee retention credit for all 4 quarters of 2021 was a startup business. So what's the answer? Make sure you understand the rules and then go back to the beginning, 2020, right? Remember now, you're receiving a payroll protection plan forgivable loan does not mean you can't also claim the employee retention credit. So run the numbers for every quarter, which works best. Even if you did not initially qualify for the employee retention credit, it's quite possible that for many of you, this will be well worth the exercise on behalf of your clients who can receive substantial tax refunds that they didn't know they had coming. What a wonderful thing for the CPA to inform the client of. We have a tax refund. We have found an additional tax refund for you. I should be very happy with you. Now we have a gentleman, if I can borrow a saying from some of my Canadian friends, who was just too clever by half. He's the victim of a self-inflicted wound. United States versus Isaac Schwartzbaum. Mr. Schwartzbaum is fighting an FBAR, an FBAR penalty. He filed a response in U.S. District Court opposing the government's motion to stop actions against him. Wait a minute. The government wants to stop, and he wants to oppose the stopping? That's it. He wants the court to retain jurisdiction in the government's suit to collect penalties because he knows that if the court drops it, the statute of limitations is run and he's screwed. That ended the court's power or authority to retain jurisdiction. No longer can he fight this FBAR penalty. It comes under the heading of lessons learned the hard way. Mr. Schwartzbaum, I think, may have been doing this pro se, but if he had checked the law on the issue, he certainly would not have been so anxious, or he would not. He knew that he didn't want the court to drop this case because he knew that the precedent in other courts was that the court would in fact yield to the IRS for the final disposition of this penalty. When they did that, now Schwartzbaum is left dealing with the IRS administrative review process. Good luck with that. Don't you love this every week? Is it doctrine or diagnosis? Faith-based healthcare cost-sharing ministry. This is particularly prevalent in the Southeast, in what's called the Bible Belt, where some of our religious doctrines encourage us to live as the early Christians lived, to take care of each other. So if someone gets sick, we all contribute to the costs. And so we should have some kind of an entity organized to collect the money and pay the bills. And that would be a healthcare cost sharing ministry. Unfortunately, this is promoted from the pulpit before anybody gets really solid tax advice, because it doesn't qualify for exemption. The fact that you're faith-based, no matter how much you believe in the higher power, there's no guarantee that everything you organize to support the higher power or your version of the higher power is going to be exempt. Here's your letter ruling reference. IRS denies tax exempt status to this organization because the IRS concluded that, one, it's not operated exclusively for exempt purposes. What's an exempt purpose? To provide a benefit, or maybe to provide a benefit normally provided by a government unit, not so here, but to provide a benefit to a charitable class. I don't think we could define a charitable class as all the Christians in Loudoun County. And its operations are not exclusively charitable, because it doesn't determine that someone receiving benefits is in fact a charity case. It's going to pay medical benefits no matter what the financial situation for the person whose ill is. And so really the activities resemble those of a trade or business. All the best intentions in the world, this is a wonderful ministry, these people are good Christians, but they can't be tax exempt in this particular undertaking. Well, employee lives in Wyoming, works in North Dakota, lives in South Carolina, works in North Carolina, lives in North Carolina, works in South Carolina, lives in South Carolina, works in Georgia, lives in South Carolina, works in Tennessee, and vice versa. Remote work complicates state tax compliance, and we've all been engaged in remote work where we were not so engaged before the pandemic. And so we've had to make some adjustments. Increases in telecommuting has transitioned into long-term increase in remote work. And so the thoughtful CPA firm is trying, and at this point, you're behind the curve, but I hope that you have made all the investments that you need to make in software to make sure that your individual tax clients with working in both states can comply in both states, and that your business clients with workers in another state are complying with the laws of that state. And I have we consider these questions. These are questions of nexus, questions of connection. A truck driver. Do we care how many trips? Yes, we do. The Multi-State Tax Commission has worked on this problem for years, and we have guidelines that if our truck drivers drive more than X number of trips into a state, then we have nexus in that state. We have to file tax returns in that state. What about a customer service representative? Well, they're sitting in South Carolina, but the customers are all in North Carolina. And normally the customer service representative would go to the office in North Carolina and take calls on the 800 number there, but it's an 800 number. So now with COVID-19 having shut down the office, we can stay home and provide customer service to the customers in North Carolina. Where was the work performed? Where were the wages earned? What are the vagaries of two different state tax laws? Here's an executive attends 12 Zoom meetings, one day each month, is never physically present in any state except his residence. Where are the services performed? Where is the value delivered? Now we've got an expediter, and this executive might have been staying home half the time anyway. Now we've got an expediter who normally worked in the office in the plant, but that office is shut down. And so the expediter is online, just as we are, working from home, doing stuff by email. You can even create a shipping label with your computer from home. Doesn't work in the plant office anymore. So now, is the expediter required to file a return in North Carolina or in Georgia or in Tennessee? Does South Carolina have a treaty with all of those states, each of those states? And are the terms of any treaty the same? I hope those are reasonable questions, and I hope that you had quick answers. More about health insurance. Employer-sponsored minimum essential coverage, more proposed regulations. They get approved, and then they're proposed. And here's the essence. These regulations address the affordability, and the coloring is mine, of employer-sponsored minimum essential coverage. Goes back to the affordability issue for family members of an employee, and these new regulations add a minimum value rule for family members of the employees that are a function of the benefits provided to the family member. So you have a new assignment, and that is to digest the application of these new proposed regulations, because they will become final, regarding the affordability rules as they are applied to employer-sponsored minimum essential coverage. You may have met the affordability rules under the regulations in effect before these changes, but now you don't. And you may have met the affordability rules, but you didn't meet them for family members, and now you don't. And so this is a project to learn what changes are made by these new proposed regulations on April the 7th of this year. CNC, in the language of CPAs that deal with collection matters, means currently not collectible. I don't care how hard you squeeze, there is no money left for the IRS. But it's not available if you can pay something, anything. And the IRS officers who are assigned to this work are not assigned to this work to be merciful and kind and gentle. They're assigned to this work to get the taxpayer accustomed to paying whatever they can in satisfaction of their tax obligations. You might try this defense that the amount is so small, the obligation will not be repaid within 10 years, and that works. But you're still going to be reviewed every year. Right now, if you make me pay something, you're not going to get any, there'll be no progress on the debt. The amount you're making me pay is less than the accrual of interest. No matter, you got to pay it anyway. We want you to be used to making these payments, and we'll see you in a year, or we'll see you anytime your circumstances change. And if you start making more money, then you're going to pay more money. The CNC classification is revisited at least annually. And it's big trouble if you lie to the IRS about your ability to pay. Robert Norberg believed he should have been excused as currently not collectible because all they could get from him was $62 a month. And the IRS offered him a partial pay installment agreement, and he declined. So the settlement officer tried to work out something where Robert could make monthly payments. Robert did not want to make monthly payments. He did not want to honor his tax liability, and the IRS has no use for that. And frankly, as citizens, we should have no use for it either, right? $62 a month. It won't make a big difference in the fisc, in the federal budget, but it's going to make a big difference in Robert Norberg's understanding of the tax law and how it works. You have to pay your tax liability. Now, our friends at the IRS have reversed their position on a tax exempt status 10 years later. revisiting a 2012 letter ruling. The concern here is a business league's provision of pension and health benefits to its members. What business league? What health benefits? What are we trying to engineer after the fact? Because I read this letter ruling, and while it protects the name of the business league, I think we can sort of smoke out what it's about. It's about providing health care benefits for a condition, an existing condition, that benefits were not previously provided for. What sort of an entity might want this ruling? Good question. And under what circumstances would the IRS change its mind about something 10 years later? Well, first of all, a business league is a 501c6. I had to look that up. Trade associations and professional associations are business leagues. Okay, I get it. The Chamber of Commerce. All right. I don't think the Chamber of Commerce was trying to get any medical benefits. Real estate boards. I don't think the realtors were trying to get it. Oh, professional football leagues. And any fan of professional sports has read a lot about the National Football League's issues with consecutive concussion syndrome, where football players have had brain damage from concussions. And now the NFL would like to set up an exempt entity to receive money and to administer a healthcare program for those football players who are suffering symptoms. And if I'm wrong, I'm wrong, but I would bet that I'm right. To be exempt, a business league's activities must be devoted to improving business conditions of one or more lines of business. That's not what they're doing here. They're trying to perform particular services for individual persons. I believe in the cause. I think it's the right thing to do, but that doesn't mean that we should bend the tax law to allow the National Football League to set up a separate exempt entity to administer medical benefits to football players that are suffering consecutive concussion syndrome. Now maybe that makes me a Grinch, but I don't think so. I think it fair is fair, and I believe the IRS finally got it right. They didn't have to deal with this issue until the NFL comes along, and it's a big amount of money. And so all of a sudden it gets someone's attention, and we've got a ruling that reverses a previous position. This is why we do this every week. You never know when the rules are going to change. Well, if you will, let's continue to meet. I'll be back next week live. Every week, this short call will feature current information about developments in administration and interpretation of federal tax law. I'll try to round up some guest experts. They've all been busy for the last 6 weeks. That'll be helpful to us. And I need your questions. I know that a lot of you either are with me on the live call or you're reviewing the podcast, because I get reports from the staff. So you must have questions. I love your questions. Send them in, even if they require analysis of complex facts. That's my idea of a good time. That's me. Thank you for sharing this time with me, and thank you for honoring me with your confidence.